Welcome everyone to our discussion number 314 on talking about everything under investing. Every Saturday, come here, get together to talk about what's happening in the market and just try to be better investor. For those who are joining for the first time here, we have our group consists of I say motley kind of investors slash traders. There are some who are long-term investors. Long term means some are 3 year 4 year time horizon. Some are like lazy as me, probably have a 10-year long time horizon. And then on the other extreme we have some who are traders who trade, who are who some of them are day traders who don't want to hold position beyond a day. Some also trade in zero DTE options. And then we have some who are swing traders. So we kind of and that's why I love this group is we have a motley, different type of investor slash trader, and you can pick up and learn from whoever gels with your style of investing slash trading. It is important, at least I've found out over the years, that it is more important to know who you are and what your risk profile is and what your emotional makeup is before you try to follow anyone else's strategy, right? So understand who you are and then maybe find people of your own tribe. For next couple of hours I will go through some of the content that I have prepared, and then we'll open it up for each one of us to meet and talk to other investors slash traders. I'll open up the breakout rooms, and we have breakout rooms for options or long-term investing alternatives, etc. So go and talk to other investors, ask your questions on details around, if you're a chartist, if you're a market technician, right? I won't be able to help you much on the technical analysis side, but we have some folks who are great in terms of analyzing charts. Ask them the right questions. Okay, so that's how generally I conduct this meeting. Andre says he's in SoCal trying to become financially independent. Job, I can quit my job. Yeah, I mean, for me, it's been 3 years since I held a regular job, and I've been focused 100% earning livelihood through investing. But I've been investing along with my job for more than 10 years. So it's been took me some years before I felt confident enough to say thank you to my job and just be on my own. You've been doing leap calls, sure. If that works for you, leap could be good, depending on if you're doing deep in the money or whatever delta you're picking up. I don't have many leap calls. I still hold a lot of stocks in my position, but leaps could be good. Could be a good stock substitution strategy for capital, to be more capital efficient. I have done leaps earlier, but I don't think I have any leaps on in my portfolio right now. All right, so before we jump into today's session, anyone else here joining for the first time? Last call for first timers. No? All regular one? All right. No, see, Jack says for the first time. So Jack, why don't you introduce yourself? And again, same thing. What brings you here, and what kind of a investor slash trader you are, and what are you looking to get out of this meeting?
Hello, can you hear me?
Yeah.
Hey, thank you for inviting me. Yeah, I'm a long-term holder. My name is Jack. Been in the stock and the crypto investing for about 5 years right now.
Mm-hmm.
Uh, and goal will be want to hear from others' view about investing and share my own thoughts with others. Yeah, that's it.
Cool. Great. Welcome. Welcome. All right. So uh, first is he's in Philippines. Yeah, 2 a.m. All right, you're still up here. So yeah, I feel so humble that you're so afraid you're joining at 2 a.m. from Philippines. So thank you for joining in. I know we have some folks sometimes join from Canada. I have someone joining from Singapore and sometimes from Middle East. So yeah, great. You know, great. Thank you for staying up. All right, so this today I want to go through um, halo trade. I started seeing this term halo, so I do want to go through that, but obviously I also want to look at a macro level what happened, and some company specific news, etc., and a quick update on crypto. Right, so that's a stand. At least I have on my agenda. If anything else you want to talk about, feel free to jump in, put in a chat. You want to talk through it, raise your hand, turn your video on, and I'll let you, you know, come and ask questions or discuss the topic. All right, cool. So let's jump into today's session. So yeah, before we get into today's one, I do want to talk about the last week I reviewed the 13F filings, right, from multiple investors. So I think right now I have data for what 96 hedge fund managers or money managers, and we did go through I think 9 or 10 themes of how they're investing across either various uh, investing themes like EVs, um, AI, chip sectors, investment in China, etc. And then also looked at if you're interested in a particular stock, how are they which fund manager is investing on those. And I did receive some messages from some of you in terms of, hey, how can you get access to it and do it on your own? So I spent some time, and now you can say I've added this on my website. So you can go to basically website optiongig.com. You can look for a like stock ownership, which will tell you in terms of you can put in your own stock and see how different fund managers are invested in this one. Give me a stock. Let's say trade as TTT. I know the Belly Gifford and Co2 management have it. So if you want to look for your own stock, you're interested in how some of the fund managers are, who bought, sold, or reduced or exited their positions, this will be a way to do it. Any other stock you want me to look at? LMT, LM, oops, LMT, LMT. Yeah, so we got not too much of interest on LMT. All right, so last week we went through a lot of individual stocks, but now you can do it on your own. And of course, the other one which I've added is around the fund manager. You can select a particular fund manager out of a list of 96 and see how they have, what their positions are, etc. And I see Samantha saying Oracle, Jalen says Snow. Guys, you can do on your own. Last week I did almost 50 individual stocks based on a request. Then I said, instead of me spending all the time and trying to go on individual stocks and see however, which fund manager has what, I would rather give you the ability to go and do it yourself. So that's why I just added over there on the website. Again, it's you just have to register. I just don't want all the bots to come and start pummeling my website with doing this analysis. So it is under registration, but it is not behind paywall or anything. I don't have any paywall on the websites, but you will have to register to get access to this. Similarly, on the fund manager side, if you want to look at a different fund manager, um, let me see if I want to see what Guy Spear has been up to. So he exited a lot of stocks in this quarter, right? Things like that. Let me put, okay. All right, so this is I do want to, as and when I get time, I do want to add some of the other themes that we looked at. I think last week we looked at almost 10 themes, and I'll add to that. I just need to find some time to do it. Okay. But at least I wanted to make sure to get access to looking at an individual stock ownership, because that probably will be useful for a lot of you, in which you want to look for what is the so-called smart money is doing with all the stocks that you own, right? Sometimes I've seen fund managers coming and talking on financial media how bullish they are about a particular stock, and then on the other hand, you will see them that they are, you know, they're oh, this is not it. So they have basically, when you look at their filings, you realize that it's a little different, right? Core V, oh, come on, what's a core wave ticker? CRWV, right? So for example, Q2 management, they talk they had a lot of high praise about how great the management of core wave is, but you look at the data, they exited their position, right? So follow the money, not what they say. All right, with this over, let's get into other stuff. And before I get into that, nuts and bolts of investment and discussion, I always want to uh, have start our discussion with some thoughts related to investing. So today I picked up thinking about risk, right? I do want to bring up a chart, which is pretty standard chart in terms of if you be into MBA or finance or look into risk versus return, right? This is a pretty standard chart of risk return trade-off, right? Anything wrong with this? What's wrong with this chart? Or is there anything wrong with this chart? Is this how we think about risk and return? That we have, if you have a lower risk, then your return will be lower. If you take a higher risk, then you have a higher potential return, right? James says risk is never linear. Okay, I get it. That risk never, move in a linear fashion. But if the higher risk investments result in a higher return, why would they be higher risk investment then? Right? Basic question. If a higher risk, then they would, if it's a higher return, then they wouldn't be classified a higher risk investments, right? Because you're getting paid for it. So I think it was 2 or 3 years ago, when I read the book from Howard Marks, there was an interesting chart in it, and that changed my thesis around how you think about risk, right? And that also changed me as an investor. So I do want to share a different way to look at the risk, which I forgot the name of the book. There are two books that Howard Marks have written. I think it's Managing Risk or Thinking About Uncertainty. There is a book, you can Google it. But I want to share the chart from Howard Marks, and hopefully it'll help you to analyze the risk in a different perspective, right? It's not that if you get a higher risk, the returns are higher always. The expected value is higher, but the variation in the returns are much bigger, right? So the prospect of high return does increase with a higher risk investment, but so is the prospect of loss. So it's, even though we look at this as an expected return, but you could actually end up over, you could end up over here and lose a lot more, right? This is a different way when I started looking at is, thinking about risk in a portfolio. It's not that you will always get the expected value, but the range of the outcomes that you could have start to increase with the more riskier the investments are. And that's where your risk management becomes imperative, because let's say if you have taken a position in out here where they have a lot of so-called risk, which is defined as your standard deviation of volatility. And if your position size is not correct, you could end up blowing your account. Even though the traditional wisdom around the return says if you own a higher risk investment, you have a higher potential return. Expected value of your return is much higher. But what it doesn't talk about is the potential of blowing your account because the range of outcomes is also higher. So that I'll share it with you. Markets have been great for the last 3 years, and we become kind of complacent sometimes. We see I'm seeing a lot of a dip buying, but in this complacent environment, this is the right time to think about risk, right? Before you start jumping into the tail end of investing vehicles with a higher risk, understand that it's even though the expected return may be higher, you'll have a much bigger variation in the returns, and you could end up either here, you could also end up here, right? Which is when you bought a stock and it doubled overnight, or you bought a out of the money call option and the stock went in your favor, right? Or the other way around is you could lose up ending up you could end up losing all your money. So different way to think about risk, which is basically based on the dispersion of values. Cool. All right. What else did I see this week? I see some questions. Ramesh says, no risk, no gain. That is true. I mean, or you be happy with whatever the T-bill rates are. Even now, the T-bills have some risk. Given the US government, what we are doing, there could be a T-bills, even T-bills may have a risk, right? Raising higher risk has higher expected value of return. That is correct. That's what the traditional wisdom is. But what I do want to layer on that is it also has a higher variations of outcomes that could come. And in one of the cases, if we hit an outcome at this level, it could just bankrupt or it could, decimate your portfolio and you may not be around to enjoy the average expected gain. Do you use options to hedge your portfolio? Yes, I do. That's my main use of options is to basically generate income and hedge the portfolio. I use options almost every day. Most of my trades will be my delta hedging trades. High risk does not create high return. Lottery tickets, speculative trading have huge risk but negative expected value. But yeah, lottery tickets are not high risk. They are a low risk. But I get your point. High risk doesn't always create high returns. I plan to do wheel strategy if possible, Netflix and PayPal. Weekly wheel strategy, not for me. Because weekly have a lot of a gamma risk and will need constant monitoring. Just doesn't suit my style of dress. I do weekly on a very few tickers where you have a high premium available. I found for weeklies, IBIT has been good. For weeklies, stuff like Palantir has been pretty good because it's the vol is generally higher and you can get decent amount of a premium for the amount of effort that you put in. PayPal, I'm not sure. Right, so PayPal, I don't know. The premium hasn't been that great on PayPal, right? And since you're doing weekly, there is a hardly enough time, any time for you to manage your position if the position goes against the stock goes against your trade, and because there is very few days to expiration, you'll have a lot of a gamma risk on your trade. I mean, basically, if the stock moves even the stock moves a little bit, your delta changes much faster than what it used to be. I would rather prefer 3 weeks, 4 weeks, 5 weeks out. I've already started building up, April portfolio. So all my trades are generally now will be April expiration, unless I'm doing delta hedging or maybe a couple of tickers that I mentioned, which I use on a weekly basis. Right, on the macro side, what did I see this week? We have ingredients for perfect storm. Right, we have a so we got a payroll numbers on Friday, and the numbers were not that great. Numbers were not good. So we had a headline numbers fell by 92,000 in February, whereas we were looking for 55,000 gains, right? So huge, almost 140K difference between what the expectation was and where the numbers came out to be. Not only that, we also did a downward revision to job numbers for January and December. I hate these numbers. Every time we have a, even I think the previous payroll numbers, we did a downward revision of 2025 numbers by almost a million. So, but it is what it is. So the overall the theme should looks to be, is the economy, is cracking up, because we are having a we are not having a good job growth. In fact, we had a job losses, right? So if you look at these in terms of any hiring, right, we're not having much. Right? Even on the Fed side, in fact, the private payrolls actually fell. Right? So generally, weak job might prompt Fed to cut the interest rate, because that could point towards that the economy is slowing down, right? And then the Fed might, sometimes I've seen that the bad numbers on the job, right? Bad numbers, which points to a bad economy, is good for the market, because then we expect Fed to cut the rates and inject more liquidity, which will be good for the stock market. But we have another theme that is going on in the markets right now, and that's based on the whole geopolitical stuff that's been happening for almost a week, right? What, 26th or 27th, when US and Israel decided to bomb Iran. And because of that, we saw a spike in the oil price the last week. And every time when oil prices spike, we all know it start to show up in inflation, right? I'm already seeing it on the pump. So I had to, I had to pump gas like, uh, I think yesterday or day before yesterday, and the numbers are already up, right? So it started to show up at the gas pumps. It will start to show up in our other inflation numbers, and because of this, the fear of higher inflation due to hike in oil prices, basically hike in energy prices, this may, tighten the Fed hands. So this is a chart for crude oil. Look at the movement that it had from close to $65. Crude oil is now 90. It was 90 on Friday. So almost like 50% higher, because of, now this will percolate into our economy in terms of higher prices. Look, energy is the base of every industry. Every industry need energy, and we see the direct impact on the pump. But all transportation will become more expensive, because you need diesel to transport goods and all that stuff. So this, we will start to see the impact of the higher oil prices into our inflation. Some economists I heard say the 10% rise in crude prices mean 25 cents higher price on the gas pump. That's just on a gas pump. Plus add other, the secondary effect of higher prices for transportation and all that stuff. Uh, it will lead to higher inflation, and because it will lead to the the fear is that it will lead to higher inflation, that will tie the hands of Fed in terms of you know, cutting down the rates. So that's a concern that market has. Now, another chart I saw was on Bloomberg in terms of the oil movement, the movement of the oil tankers through the Hormuz Strait has almost died. I think there was a news that only like tankers that from Iran bound to China are passing through Hormuz Strait. All other tankers have decided to stay back because they can't get a good insurance, or the insurance company has refused to underwrite it because of the higher risk. And we did see White House coming and saying, you know what, we're gonna reinsure you. So there is a $20 billion reinsurance program that White House has announced, so that these insurance companies still provide insurance to the tankers that are passing through the strait, to make sure that in the world, the all the oil that is required by the countries, they can still get their oil supplies. But otherwise it's going to be really tough. If we can get the oil out, all the refineries, once your storage capacity is already full, the refineries will have to start cutting down their production. What if they have to shut down some of the refineries or oil wells, right? Then it's not going to be easy to restart it, right? So even though we might think that this whole war will be over in a week or something, we may not be able to get back to the same volume of oil production, because once it's not easy. It's not like on a switch of a button you can just turn on your oil production. You can turn on your refining capacity, or the exploration of oil from the well. If you shut down the well for one, it will take a few days to a weeks to turn it back on, right? So be ready for if this doesn't get resolved soon, and if the oil companies start to shut down their wells, the refining companies start to reduce their output because they are not getting enough supply, be ready for a longer duration to get back to normal scenario. Right? I see a hands up from Sam. Sam, you know the deal. I need turn your camera on, and I'll let you ask her question. Go ahead.
Um, Two things. Back in 2005, in the winter, I remember listening to NPR, and they said like inflation was like 5 or something%, not including energy and food prices. Then I thought, well, what does that mean? 5%, not including food and energy. That's more or less all our budgets, right?
So
That
so
means
that's
nothing.
So, Fed generally looks at PCE, which actually does not include your food and energy prices. I don't know why they do it, but because food and energy prices are generally more volatile than the rest, Fed excludes it, right? So there is a there is a contrary thought around inflation, if we want to entertain that for a minute, which is, I think the PC numbers will be out. I don't know if, whether it'll be impacted by the recent happenings or not. But if Fed only focuses on PCE, which does not include energy prices, so the PCE number probably will not increase. And now, but in actuality, in practical life, you are spending more money on energy, more money on gas, which means less money remaining to spend on other stuff. That means less demand for other stuff. That also means maybe lesser inflation for non energy stuff, which does get included in PCE. So, by some weird math, and I don't know, it's just a speculation, right? Could we see a lower PCE number? I don't know, but it's a different way to look at it, because Fed focuses on PCE, which does not include energy. Even though I 100% agree with you, Sam, that that is the biggest budget for us is food and energy, but because it is generally more volatile, Fed is this. I don't know what's the reason, but Fed does not include it in calculations when they look at the monetary policy.
Second point,
Yeah.
I watch old TV series, so I put it into Google. Sorry, yeah, I put in Google AI or Bing or whatever. But I said, Gomer Pyle earned $10 his first season. How much would he earn now as a training Marine? So his got up 30 times since 1968 or something like that. But
Mhm.
the but the CPI has only gone up 10 times. So you see this inflation
So,
figures is very inaccurate.
and I don't think that's a surprise. So you may want to look at something called Trueflation. I think there's a website which actually tracks Trueflation, which looks at the actual numbers from, let's say, the supermarkets. When they look at for a real estate inflation, they look at, let's say, Redfin or Zillow and pick up the actual numbers. The government numbers are based on some outdated methods that have been around for, I don't know, God forsaken 50, 60, 70 years of using surveys, which is a pathetic way of doing the work. Now we have a technology to get real numbers pretty soon, on a real time basis. I don't know why the government is not using it, but government moves slow.
Uh,
Anyway, sorry. So let's move on. The other thing which I think the market little bit concerned about is anytime we had a tension in the Middle East, it was kind of accompanied by some recession, right? This is a chart again from US Fred. 1970s, 80s, 90s, 2010s, little bit of a oil price spike, which is leading to recession. So right now, little bit of the concern in the market is, gosh, we may enter into recession again. We don't know. It depends on how prolonged will this can continue. But if we do, there is a fear that we could end up into recession. And looking at the job growth, or I would say job losses, which means no economy growth plus higher inflation, that leads to the dreaded S word. What's that S word? No growth and high inflation. Yeah, Rajiv got it right. Stagflation. Everyone hates stagflation. This is where we'll be most concerned about is getting a stagflation. Right? Inflation is okay as long as your GDP continues to grow at a higher rate than inflation. But if we are not growing and if we have a higher inflation, that's like worst of both worlds. So we saw sell off across bonds, equities earlier this week. It was a huge, let's say, risk off move. Like no asset was safe. That was a classic, I would say, fear or desperation call, whatever you may. We were into that cycle where market was selling off everything and anything that they can get their hands on. And I think that was 3rd of March. So I did share it on, I think, on the Slack channel, that I, I think in 2023, I decided to basically put a note to myself whenever I've seen these drastic moves in the market, and those are like little bit, you know, uh, challenge you emotionally. Right? At the end of the day, investing is all about emotion. So I did put out this note. Let me zoom in uh, so you can read out this note. Right on third, I put it: U.S. Israel war with Iran, supply chain disruptions lead to increase in oil prices. World over, we have inflation worries. Gold was down 5%, SPY was down 2.2, IWM 3%, Nasdaq 2.5%, Bitcoin down, silver down, VIX was up, only dollar was up, bonds were down. These things have happened only 2 times in the past 6 years, right? Worldwide, we saw Korea was down, Taiwan was down, developed non-US EFA that was down, everything was down. So I did put a note to myself like, gosh, don't do anything stupid. Doing anything when everyone is selling off, trying to sell off that point of a time is a stupid thing to do. Just stay the course. Maybe buy something that you always had your eye on, um, and when market presents that opportunity, but just don't do a stupid selling. It helps. If I go back and like I said, I started putting these notes since 2023. I went back and looked at the note of during the Liberation Day, how I felt, and put on my note at that part of a time. It just keeps you honest. So if you want, it's a part of a journaling. Just go and put a note of how you're feeling in that particular day, right? And then you realize as you go back through some old notes that my gosh, those were the very bad days. Those are the It was painful while going through those days, but then in a long term, didn't really matter. Didn't really matter much, right? So on a big picture side, going back to we looked at on session 281, we are back at the same place. In session 281, which I talked about and this was after the US had bombed Iran, US bombed Iran nuclear facilities. We had a similar risk of sentiment. And this is basically just copied from our previous session. Right, let me go back to that 281. I think I probably have the document ready for that already. This is 281. Yeah, we went through this, how to navigate market uncertainties. Where was this chart? Uh, Correct. Market behavior post geopolitical tension. Right. So I went back to that and said, well, what did we see there, right? And went back to this chart or table that I discussed in session 281. We had so many geopolitical shocks, but if you look at how the market has performed afterwards, has done okay. Not that bad. Right? So if you're a long-term investor, staying invested through these disruptions has been a great strategy. Right? So how do you navigate this? If you are, like I said, I've covered it in session 281. Maybe you go back to that and view the recording. We talked about, maybe look at review your safety net, look at your portfolio, how well you are diversified and all that stuff, right? So 281, you can go and view the recording on the website. In terms of you're feeling similarly, if you're feeling a little concerned because we have a similar kind of a situation here, uncertainty in the market, you can go and review this. Okay. I see some comments out there. Oil prices going up due to war will impact the inflation rate. Yes, with the prices have already gone up. Nitesh, are you still driving gas car? I have a hybrid. So I don't think I will buy the fully EV because I have a charging anxiety. If my cell phone is down to 20% charge, I start to feel anxious and my kids laugh at me, but it is who I am. So I don't think I'm gonna get fully EV. Uh, I'll Both the cars that we have are hybrids. But government will now remove oil from inflation. That's true. I don't know. I mean, the government numbers, I don't know how much you should believe it, but it is. But the Fed uses the number, and hence we basically talk about these numbers here. Shipping lines have stopped shipping. What's your take on the software flush? We'll talk about software. Jalen, just hold on. I did talk about all this AI graveyard on the SaaS in some of previous sessions. So, but today I do want to talk about that again. Nice setup, Tom. Yeah, Tom's screen has got like six or eight screens. US oil ETF was way up. Probably true, right? Let me look at USO. Again, a lot of these oil ETFs, the crude oil ETF or the crude oil, probably did great this week. I mean, the energy sector itself, if you look at a SPDR energy sector, that itself is up like 25% a year to date. USO is up 57% year to date. Do you put this on Excel? How did you create the chart? I don't know which chart you're talking about, Jacob. Oh, this one? I mean, I'm not sure which chart. Can I get a copy of it? No, I actually post the recording. So if you want, you can go back and look at the recording. Tom says our report detailing past conflict-driven spikes, rising crude price will be a headwind for the stock market until that date. Yeah. For till 323, shall I put a line in the sand, Tom, saying 323, let's go all in? Oh, yeah, if you want to speak up, you can, sorry, you can unmute yourself. Let me see. You want to talk through it? Go ahead and you can unmute and let us know your thoughts.
It's just around that date, right? So, and that doesn't mean we get to that date and then prices fall dramatically. They could go sideways for a period of time as well. So I just view that as a headwind for the market up until that point in time. I think, if anything, people may be surprised how high things go in that short period of time. So it's just a headwind, and but a significant one, I believe, because as oil continues to rise, whether it's only short term, I get that. Whether it's offset by weak employment, I get that too. But nonetheless, it is an inflationary impulse that I think would temper the Fed's desire to lower rates, despite what they're saying now in the media. I think they're trying to talk down rates. If you believe in the market, the 10-year Treasury's back up 415 area after being 395 2 weeks ago. And typically in a war setting like we have now, rates would have fallen dramatically in the longer end of the curve.
Yeah. Where is Jose? Do I see Jose here? He also has a good pulse on. He generally has a good pulse on the commodities, and I think he does trade a lot of commodities. I don't trade commodities, so I just wanted to see if he's here, see what his thoughts are. No, I don't see him here. But thanks for sharing your thoughts, Tom.
Sure.
Yeah,
excuse me. Trump made mention of the Interior Secretary Bergrum or something. He made some comments towards the end of last week saying he and Trump are going to promote initiatives to temper crude prices. There's not much that they can do. They talked about releasing oil from the SPR. There's not much there, as far as I know, to begin with right now.
Did we not refill the SPR?
It's not going to have much of an impact on the world crude prices.
Yeah. I mean, US is not dependent on imports, but the rest of the world is.
Right.
Yeah. And I don't know if we refill our SPR earlier or not. I do know earlier we depleted it, but I didn't track it if the SPR is refilled or not. How much oil do we have in our SPR?
Yeah.
Anyway, I mean, historically, this is not the first time that's going to happen. We have seen this time and time again, not just with an oil price, but historically, any geopolitical tensions, it is difficult to go through these times. But, unless we end up into a nuclear war, the third world war, we'll come out okay. And if we actually get into a nuclear war as a third world war, then the portfolio will be the last thing that I want to worry about anyway. So, so if we get a nuclear war, don't have to worry about portfolio. If you don't get a nuclear war, we'll come out okay. And this may be a good time, to maybe dip into some of the stocks that you want to own because the market is selling off everything, right? Uh, I think I read on one of our some group chat, someone had posted that they have read somewhere saying when when you see missiles fly, it's a time to buy, right? So we haven't. Anyway, you do what you want to do. I I am not selling off. I just managing my deltas like I have always been. I've not made any drastic changes on my holdings or a portfolio. I understand there will be next few months will be difficult to get by, but then I don't have to worry about next few months anyway. I mean I'm protected in terms of for my expenses. Even if the market doesn't perform for next 6 months or a year, I'll still be okay.
So Vivek, I understand you're trying to just basically ride this through, right?
Yeah.
The sun will come out again, when this conflict is over. However, how in the interim do you couch a risk like an Iranian individual or terror cell committing active terrorism on U.S. soil? There was one person in Austin, Texas, that shot up a bar last weekend that was apparently affiliated with or considered an Iranian sympathizer. So, but if we get something more significant than that, and it only takes one person to, do a mass shooting or something, don't you think that takes the stock market down a fair degree?
Sure. I mean, we had a 9/11, right? I don't think at that degree we'll get to that degree, but then we recovered. And and the idea is, and if you've been attending this session, you know that I'm looking for if for next 1.5 years, I've already have stashed enough of a cash, etc., for me to survive. Number two, if the VIX goes higher when the market goes down, you can get a lot more premium by selling, options around it. So, for example, so far, these whatever 2 months have been the best 2 months on terms of our option premium income that I've made this year. So I made enough of, I think it's almost half of what I did the last year, or little less than half of what I did last year, because the VIX has
Good,
been like above 20.
good points. Maybe you wait till March 23rd and then sell your puts.
Yeah, maybe I'll do that. Right now, I have a lot of call selling that's going around. I did sell because the VIX was like 28 or 25. I did sell a couple of broken iron flies on QQQ and Aspire, right? So basically, almost no risk on the put side because that was capped on the put side as a put spread. But on the call side, I just had a naked call. I just wanted to take advantage of the higher VIX. So,
Thanks for letting me share.
right. All right. Fear and greed index. We're still okay. I mean, I've seen this fear and greed index at a number 9 or 7 in a single digits during the liberation week. So we're not there yet. I think 27 is still okay. Uh, I'll start deploying more capital or become on the bullish side once it's move into the extreme fear. It is very, very difficult to do it when the market in extreme fear that you take an opposite side. But at least I have seen that over many years looking into the market, those are the best times to buy when everyone is selling it out. And when you move to the net neutral and greed, that's the time when you start, at least I'll start selling a lot more higher delta covered calls. When everyone wants to buy, yeah, take it away from me. I'll be happy to sell you. Uh, crypto, not much changed. In fact, last week crypto was in more fear, but this week we did have some good news on the crypto. So I saw a little more positive sentiment on crypto this week. Sector wise, again, energy is the top performing sector year to date, up 25%. And this is where the diversification in your portfolio helps. If you go back and look at the last year, energy didn't perform much. But if you had, if you're not diversified and were only in a tech because tech did perform last year, this year tech hasn't performed. Especially the SaaS companies that have been darling of industry for 10, 15 years have been beaten down for this year. Right? Many companies are 40%, 50% off. So always pays to diversify your portfolio. And, if one sector is not working, some other sector will. And if none of the sectors are working on a particular day, then that means it's an incessant selling. Everyone is selling everything without even thinking about, anything in the future. That's a time when I would actually go and try to shop something in the market. Because then people have stopped thinking. You are selling the off risk assets as well as the risk offs like gold, etc., as well as you're selling the equities, and you're selling internationals, and you're selling anything everything else. That's the time when you say maybe this is more than a thoughtful selling. Maybe someone is being forced selling, right? That's the time when I actually love to shop. All right, so this week I didn't buy no individual stock buying this week for me. Uh, last week I think I did mention last week I bought like think Mercado Libre, but not no buys or sells this week in terms of from a stock perspective. Challenge says buy without fear. The world can only end once. That is true. But again, depends on what's your outlook is, right? If you're depending on your income from your portfolio to survive for next 6 months, I can completely understand why it will be a very unnerving moment for you, right? Because we don't know what's going to happen in next 6 months. I have no idea how long this conflict can continue, right? Even though administration is saying like we have a strong upper hand, we never know. I don't know what the truth is. So I'm ready to wait it out for a year or like look at the Ukraine and Russia war. What we have completed 4 years now, and we still don't know how long can it continue. But again, for me, it's a long-term game. The market investing in, and if you're diversified, you have you don't need the income from a market to survive for next 12 months. Yeah, I'll stick around. John says 37 more days. Uh, Tom whispers of September. I have no idea. Do you also follow real estate market? What's your read on the current context? I do not follow real estate, Sushma, because I think for me, I'm much better. I can get much better uh, overall return profile in the equity market, decent liquidity from a return perspective, if not better than same as a real estate. So I don't invest in real estate as an investor. My only real estate investment is my house that I own. So I don't follow real estate market. Alina, you have your hand up. You need to turn your video on and go ahead and ask her question. You know the deal. Right. So yeah, maybe once your video is on, I'll ask you to unmute. All right. Moving on. Otherwise. to that a topic around Hello World, right? Oh, maybe I gave it up already. Okay, without Googling, what is Halo? Elena says the host is not allowing. Yes, I'm not allowing. You need to turn your video on, then I'll allow you to unmute. We agreed on this protocol from previous meeting. I learned it from one of our company's annual meeting I was listening into. I actually was watching on a YouTube and I like the idea. I don't know who bought. At least want to get a feeling that I'm talking to a real person and not the bots. Turn your video on and I will allow you to unmute. Go ahead and ask your questions. What is Halo? Don't Google it. But I saw this term in the media. I thought we will talk about this. Any guesses here? Especially on the Sassacre or Sasso lips, this has become so famous. All right, no guesses. So let's talk about it. So Halo is more of a heavy or hard assets, low obsolescence. Over the last, I would say, couple of months, we have seen in the market one theme, which is AI is going to obsolete all these SaaS companies, right? Which are mostly asset light companies, and that's why we love those asset light companies, because you don't have to invest heavily in them, and the overall your return on invested capital is good, and that's what market loves, and market pushed up the valuations or the pricing of those companies. And then suddenly over the last 2 months, the chatter in the market is AI is going to eat up all those SaaS companies, and but AI cannot eat up the physical infrastructure, right? If you need to do even that applies even for the jobs. So AI can eat up some white collar jobs where all you're doing is analyzing the, let's say, analyzing the data and um, writing the reports. But if you're in a physical job, talk about plumbing, like, or being an electrician, AI cannot do it, right? So they've been focused around, let's invest in the companies which will do our own heavy assets, right? From a capital light to capital heavy, because those will be the least disrupted, or the market thinks that those will be less prone to disruption from AI. Right? So this strategy focuses on the companies that own massive, tangible, physical infrastructure. Now, which is completely different thought, right? We're going back to 1970s and 1980s, where we gave a lot of premium to big conglomerates owning heavy industries. We're kind of a throwback to that area, which are effectively immune to be replaced by digital algo. Right? Heavy assets like factories, pipelines, land, machineries, data centers, servers, right? Something that will give you more in terms of regulatory approvals, etc. That you cannot use AI to push through it. You can use AI to cut down our software development time, but if you're dependent on government approving, or giving approvals because it's a regulated industry, and if you're in that industry, it cannot be easily disrupted by an upcoming new company, because hey, government will take its own sweet time. Low obsolescence, whose core product or service remain essential, right? I still gonna eat food. Food still need to be delivered. Right? Physical goods need to be delivered. Digital goods can be downloaded, but not the physical goods. So that's why now over the last 2 months, I'm seeing a lot of chatter around this Halo trades, which is what's driving and what is driving this. We looked at AI obsolescence fear already. Great sector rotation. If you look at it, SPY hasn't done much. If you look at SPY, hasn't done much for a year to date. It's kind of a down for the year to date. But if you look at RSP, which is an equal weighted SPY, only if Think or Swim can give me an update. Let me go to some other site. Let's look at here. RSP. I don't have a year to date out here. Oh, there we go. RSP is up 3.44%. Because the money has started to rotate away from some of these software companies that, those the one that dominate the SPY, big market cap companies, tech companies, it has started to rotate to other companies. That's why if you look at a equal weighted S&P, it's actually up 3.5% almost. So the sector rotation is happening, and third is your inflation and scarcity, right? All these global supply chain getting disrupted, and the demand for oil, copper, and specialized machineries on all that. So folks are thinking, hey, we will need copper because there's so much demand for of electricity generation from data centers, and you'll need copper to for transfer of your electrical energy, need for oil, etc., which basically drives all the industrial companies, right? Construction needs for constructing these data centers. Again, industrial and heavy machinery companies are involved in it. So all these are actually driving a lot of the demand for companies that are heavy asset companies. Right? So what's included in this Hello basket? Energy and utilities, because you cannot just replicate the grids, pipelines, and all that stuff. Transportation, industrials, companies with the big supply chains or global stores, then materials. And no wonder that some of these sectors have performed better this year as compared with our software sector, right? So I asked Gemini that if we were to look into this Hello trade, what are some of the companies that might that are could be in this basket and where they are from their 52-week high, right? Gemini threw up some companies. I think Goldman Sachs, they sent out a report, and I tried to find the report. I could not find it. They sent out a report updating their March Halo list of companies to their clients. They, I think, included ConocoPhillips and another company, Lower Holdings, in their March report. But Gemini prints out these companies which could be a potential for your Hello trade. Right? ExxonMobil, Union Pacific, which is on a critical rail infrastructure, Caterpillar, which are your construction and mining equipment, John Deere, agriculture, heavy machinery, McDonald's, real estate giant, global network. This could be one reason why Walmart is trading where it is. I look at a Walmart, and if you've been wondering why is someone willing to pay 42 times forward PE for a consumer staple company, the reason is this cannot be rendered obsolete by AI. Now, have some of the investors taken it too far? Maybe. This always happens. Whenever you see the market looking at at least what I've seen is whenever you see these phrases, coined phrases start to appear in financial media, market then basically takes it to another extreme, right? I don't know what that extreme is. Maybe I wouldn't be buying Walmart at 42 times the forward earnings, just like I did not want to buy Costco. Was it last year? Like everyone was talking about Costco. I'm like, come on, Costco was like 50 times forward earnings. I don't know where it is right now. 46, not anything better. But I think as an investor, you will still know that 10 years later, Walmart will still be around. But I don't know how many of these SaaS companies will still be around. So that's driving a lot of I would say investments into some of these sectors, which for last 10-15 years haven't found so much of a love. But right now, these are the sectors which market is thinking, gosh, these can't be disrupted by AI. And that takes me to, let's look at various sectors. Come on, but the charts have stopped working, so I can't look at that right now. Few other companies, Coca-Cola, Nutrien. I've never heard about this. FedEx, Nextera Energy, Waste Management, Vulcan Materials, Linde, which is industrial gas plants, CSX, which is rail, public storage, ET's energy transfer, right? And then few more. By the way, Vulcan Material. Anyone have ever bought Vulcan Materials or ever invested Vulcan Materials in their lifetime? Let me ask this question. And there's a reason. I think Vulcan Materials has been the best performing stock in the stock market history. If not the best, probably one of the top best. I don't know whether the Monster is number one or whether the Vulcan is number one. And all it does, it deals in the stones, gravel, and all that stuff. But this has been the best performing stock. This company has been around for ages. All right. So that brings me to another one, which is if Halo is everyone is piling into the Halo trade, is a software dead? I'll come to that, but let me read some comments. Effect hard asset, real estate, farmlands, commodity. Yeah, that's why we're seeing all these commodities, etc., going up. Dave says that the recording go on YouTube and it goes, yeah, and it's perfectly fine. You can always put your question in the chat, right? And it does tell you that you're being recorded. So if you're not comfortable, put your question in the chat. Would insurance companies fit a Halo trade? Not Halo trade, but I don't think it can be disrupted by AI. It would be helped and enabled by AI. You can have a better risk models if you can use better technology. I don't think it can immediately be disrupted by AI. High obsolescence assets, software, fashion, electronics. Fashion has always been high obsolescence, right? And let's say the fashion and the fads, by definition, fashion is high obsolescence because fashion keeps changing. Jealous, how do you feel about MDT? MDT is which company? Oh, what ticker is MDT? I thought it's Mandia. It's Medtronic. Not followed. This is a medtech company. I've not followed it or not owned it, so I don't know how do I feel about it. I can maybe quickly look at it. Not great, but not too bad as well. It's not a hugely revenue growing company, but it's a pretty mature, seems to be a good, decent revenue, nice operating and the net profit margin. Probably, I don't know if it buy back the shares, etc. I can look at if it does any share buybacks. But it pays nice dividend. So it's a decent business. Right? won't be mad if someone holds Medtronic in their portfolio. But what the stock is gonna do in next 1 to 3 years, I've not owned this company. But from a stock hasn't performed for a year. Right? From valuation side, it is right now. It's not too pricey. Maybe it is because it's not a growing business, but this give you almost 3% dividend, buyback share between 1 to 2%, so you got a 5% return, right? And if you're happy with that, maybe it's a decent bet. Again, don't go and invest based on what I say here. I have not followed this company, or nor do I own this company, but this is what I quickly looked in, like these 2 minutes, quick looking at the financials. Dave says, what is WM waste management? Through all materials industrial can be considered hello stocks. And also Linde. Sushma, what's your guess how long this war will go on? I have no idea. Right? No idea. Follow Trump. If you follow Trump, they should have been over by now, man. I don't know. We never made money following politicians. Jacob is asking, are you thinking the next sector that will boom will be industrials? Even if AI continue to boom, we'll need to start building data centers. See, the question is, even if the sector booms, are the stocks already moved ahead in anticipating this boom? Right? We definitely know that if you have to build all these data centers, provided that we build all this, because I'll also share in terms of how some of the projects have been now having second thoughts and they're not building it. But provided if you have to build all these data centers, yes, we will need a lot of industrial or data center related physical infrastructure companies. So you will need that. The question always is, when it comes to investing, is how much are you willing to pay? Because if it's not a news, it's not something new. Everyone knows that we need it, and they might have already bumped up the price, assuming that these companies' revenue is gonna grow up. The question is, how much are you willing to pay? I think someone has said it. Some great investor said that it's to make money in the market, you don't have to buy good companies. You have to buy companies good. There's a difference between these two. Buying good companies is not enough. You have to also make sure that you buy those companies at a good price. In case of euphoria, we forget about buying good. We all buy into high growth, great companies, future is bright, sales are doubling year after year, and this is gonna continue. We assume that it's gonna continue forever. That picture doesn't end well. Didn't end well in 2000, didn't end well in 2021, and probably for many companies in the AI segment won't end well in whatever 2026, 2027. I don't know when this whole I mean, even we already start to see many of those so-called high-flying, high revenue growth companies cut into half already. Some of them probably will go even further down. So to buy the companies good means at a good price, whatever you're willing to pay. I don't know if you're looking at individual companies, you have to decide on individual companies and see, what's their revenue projections are, but then what's the price are you willing to pay? H. Johnson, are you using paid versions? I am using paid versions of Gemini, but stock related analysis, I've not used anyone else, so I can't tell you whether it is better than Claude or Perplexity's paid version, but it does a decent job for me. I mean, at the end of the day, I always take my own decision. I don't let Gemini decide for me, but I will ask the questions from Gemini, and I'll get a response from it. And then I'll decide what I want to do with it. I don't let Gemini make a decision for me, but Gemini doesn't understand me. What edge human stock traders will have playing against AI agents deployed by other traders? Probably nothing. I mean, if there's a trading strategy in which you have no more other can replicate it, you will lose that strategy will fizzle out. That's why I'm not a big fan of buying or aiming into some specific strategies, because if everyone has figured it out, then there will be nothing more to exploit. What and I'm not intelligent enough to find or to to go against the well-paid, lot more intelligent people from Wall Street. But what I feel, and you have to figure out where your strength lies, is from an emotional perspective and from a duration perspective. I think that's where my edge lies. So when Wall Street will be selling off some stocks because they cannot look beyond or don't want to look beyond a year or a 2 year, and they know that for next 2 years the stock will be depressed, I will be willing to go and fish on those stocks. My edge lies more on that side than doing any kind of a technical analysis or trying to trade on every ticker, right? I think the bigger traders or hedge funds have much better access to information as well as the computing resource than me as an individual investor has. So I don't even want to play in that game because I know I have no edge out there. Okay, coming back to our Halo trade. If Halo tells us that we need to invest in heavy capital, heavy industries, does that mean it's a software debt? I mean, that's what we're looking for last 2 months, right? Market has given up, has already kind of reached a conclusion that all these software companies are dead. We go back and look at, we created a list of AI graveyard. I think I'll gonna go back and look at that again. But I saw an interesting article, or I forgot, was it a blog post or was it a news column in a newspaper from a software company CEO. And I really like that, his way of thinking. And I think we also talked about it 2 or 3 weeks ago, wherein market was swinging to another extreme of saying all these SaaS companies are dead. I'm like, come on, it doesn't happen that way, right? Right now, all the software stocks have fallen into bear market because the market is afraid that artificial intelligence will upend it, right? Especially the vibe coding stuff, right? That companies can now generate working software applications with minimal assistance from outside. You can hire a developer, a junior developer, they'll vibe code your software. So software companies will lose their pricing power, right? Your contract come up for negotiations, you will say, let me talk to Claude, let me talk to Anthropic, I'll get back to you, right? But what Claude does is allow you to create a software at much lower price on your own. But this is not the first time that the software has become almost free, right? Open source software. I personally have worked in companies that whole business model was based on the free software, right? The software was free. The code is free. You could actually go and download the code for my company's website, right? Linux is free code. It's an open source. But a Red Hat built a multiple billion-dollar business, and then it got acquired by IBM, and it's continued to be a revenue generator It's not easy to build business on an open source, but there are companies that have built businesses on a software which is essentially free. So that does tell us that when you talk about a software, it's not just code that the companies pay for. There has to be something else. The code is free in open source software. There are some other things that you will still need if you want to run your applications, your business on that software. Right? So, sure, vibe coding could bring down the cost of your software, but even in free software, companies still pay up. They don't run their business on free software. Open source has been around for 20 years. 20. I remember in 2000, 25 years, or was it 2003 or 4? In our company, we had installed something called Star Office. Anyone remember Star Office? Is it still around? That was an open source, free software or applications which was competing against Microsoft Office. And if you know Microsoft, they charge a lot. And our company was like a startup. We didn't have too much of, we wanted to save every penny wherever we could. So all of us had moved to Star Office. If someone can Google and tell me if Star Office still exists or what happened to it, right? So there have been a free database softwares, right? MySQL is free. No, I think now it's probably Oracle licenses it, but you can download a lot of open source software. You can have Apache from a web server perspective. There's a lot of software in the stack, tech stack. You can find free versions of it. But still, over the last 25 years, software company margins, proprietary software company margins, and their pricing power haven't gone higher. The best investments from an investor perspective in the last 25 years have been software companies. That did put a dent in the software companies. So the question is, why didn't the free software code ruin the business of software companies that were charging money for the goods that you can buy for free? Because software buyers want more than just code. I don't want to run my business. I can have fun with the free software, but when it comes to running my business, I want someone to support if I get stuck, especially if my core business is not creating software. My core business is pick up anything, right? If I'm a waste management company or if I'm a construction company, can I vibe code a construction payroll? Sure. But tax laws changes, would I want to keep a team of or a few people around so that it can keep up with any changes in the tax laws, etc.? Why would I want to spend money on that one? If anything happens to the software, would I want to run my own support? Probably not. The biggest stuff will be CYA. If I generate wrong 1099 and my employer sues me, I'm liable. In other way, I can go and sue whichever company I'm using for payroll, right? So you need a support, you need services, you need upgrades. Nitesh has mentioned you need security fixes. Who's gonna focus on all that if your business is not on the software side? I want to focus on my core business of creating construction equipment or farming, or if I'm a hospital, I want to focus on a patient care. I don't want to deal with the tensions of managing software, right? So that's where if the free software could not disrupt the software companies, I don't think this AI is going to disrupt all the software companies. There will be some companies that will go out of businesses. Don't get me wrong. There will be some companies that will still be around. Right now, for the last 2 months, we've given up think all the companies will go dead. Second thing, AI is probabilistic, right? It's not deterministic. So in the situations where you need to have 100% accuracy, mostly when it deals with patient health or we're dealing with the regulatory or compliance issues or customer relationship, you want 100% accuracy. You don't want to ship W-2 to your employees saying, yeah, it's 95% okay. Right? You don't want that. You don't want to have a 95% accuracy of getting your paycheck in your bank. You want 100% accuracy that your paycheck will be delivered in 2 weeks. AI, by its own definition, and the way LLM works, it is still probabilistic. And over the time, we are seeing the probabilities, the probabilities become better and better, but it is not deterministic. So in cases where we need 100% accuracy, it's not going to be a substitute. Right? I can skip all that. In a crucial way, AI generated code will even be lesser useful and valuable than a open source code. And when open source code could disrupt the software companies, the chances of AI generated code disrupting software companies are even thinner. Why it will be less valuable? Because if I'm vibe coding or software, it is only specific to my own company. Only the person who's involved in it, only the person is given instructions to code generator knows what's gone into it. You can't use it for other purposes. Whereas on an open source, there's a community, big community that develop the software. A lot more people know about it. There's a lot more adoption of it. Right? If you run into an issue, maybe you can go to the community and ask questions, get some solutions. Right? But if it's a vibe coded software, there's no one else to look around. And God forbid if you're one developer that worked on it quit, then you're on your own. Right? So it's not gonna, disrupt all the softwares, and also the sophisticated applications is not just a code on its own. It will have integrations with some other software. It will have integration with your own business rule, data sets, and all that stuff. Right? So I understand the Halo trade. I understand why market is super excited about the Halo trade. But what I'm also looking at is the other side, which is market has given up all these software companies for dead. And I don't think collectively this sector is going to go dead. Collectively, the SaaS sector will still survive. And as you guys know, I started building positions in IGV maybe 3 or 4 weeks ago because individually I don't know which company will survive or not. And the other thing is, anytime we see these technological changes, and if vibe coding has made creating a new software so easy, much lot more quicker, all these software companies will be adopting the same practices and will be creating software at a much cheaper rate, which could lead for them for better margins, right? So their own operations will become much more efficient, and they will be the one who will probably enjoy the biggest benefits of vibe coding tools, and not the ones whose business is not creating softwares. Right? They will be the one probably who will be able to develop the software at lower prices and then can expand. They may be able to expand their business because now they can sell it at a lower price, and hence can have a bigger set of a consumer that they can or customer that they can sell it to. So I'm not giving up on those companies. We looked at these graveyard companies previously, so let me go back to those and see how they are since we last looked at it. right? Some of the companies like Duolingo, right? I don't think that might come back because that's business model itself is disrupted. Now, earlier we used Duolingo because I had a need to, and this not been disrupted by the vibe coding, that it's been disrupted by the, the active translation, right? Earlier, if you were traveling to a foreign country, you want to communicate, at least learn some words so that you can survive, you need to learn that language. But maybe with these active translations, there may not be any need. Company like Czech, I don't know why wouldn't someone use Czech when you can just ask the questions to LLM, it will give an answer immediately. I don't think Czech will want to survive. How about Intuit? Why is Intuit is now like down 27, 28% year to date? Intuit have had challenges because people hate paying for TurboTax. But can you and would you want to take a responsibility to create a viable software which understand every tax nuances? Probably not. That's a domain knowledge which basically Intuit has as an advantage of. I don't think you can throw out an Intuit just like that. Companies like I don't let's pick up other one. Udemy, I don't think Udemy will survive because now I didn't have to learn how to create a code for some of the stuff that I'm doing. I just asked LLM to do it. So my own concerns around some of these come like Udemy. Snowflake is down 17% for a year, 25% 5 years. Forget 5 years because the valuation was like 80 times sales. So that's gonna happen. But already down 17, 18% for a year. They think this is gonna go dead? No, so Snowflake holds your data, right? Or have if this is where your data lies, if this becomes a system of record, then you will still need it. I don't care which one is your analysis layer. Things like there's another company, right, which SAP. I don't have SAP in this. Well, let's see. It's a similar, like SAP was beaten down because of the concerns around, come on, vibe coders will replace it. You're not gonna create a whole new ERP. And SAP is already a system of record for hundreds or thousands of companies. Right? So, Kane, I think, and it's difficult to know which one will survive in next 10 years, which will may not. There are some companies which I think will, some companies probably not. So my preferred way to get an exposure was through IGV, which basically has a lot of these companies which we have given up for dead. So, because I don't think we're going to be dead. So that's around Halo trade and kind of a anti-Halo, which is like, hey, software is not going to go dead. So you decide based on what your thought process is, what do you think about these software companies, and what do you think if vibe coding can replace these software companies, and make a decision based on CrowdStrike, right? Come on. Will I depend, will I put my business on the faith that a developer that I hired has vibe coded a software which will basically thwart every hacker in the world, or will protect me every cybersecurity hack? Come on, never ever gonna do that. Right? And these threats change every second. And then we look at CrowdStrike is down 20%. Because I think Claude had released a plugin to create a cybersecurity software. Sure, I'm not never gonna put a business on that software, right? So look at individual company and then see, in terms of, is any serious business will do it on its own, especially when the business is not to create software. Right. Okay. Asif is asking, IGV down 30% would have been 80% if the fear was that SaaS is dead. I think for me, I think 30% was also too much. Now, will there be a valuation correction? Yes. Will you be able to have the same pricing power for the next 2, 3 years? Probably not. Until this whole, it becomes clear that which company is going to survive, right? For next 2 to 3 years, while these AI companies continue to churn out new models and maybe new modules related to your industry, market is always going to come back saying, why, or the consumers are always going to go back to this company and say, why do you charge me so much? Let me have a discussion with OpenAI on their latest model of cybersecurity. So your pricing power will be impacted in a short term until we become clear, which will take maybe a couple of years to figure out which industries will actually be disrupted and which industries will still survive the onslaught of AI. James is right. AI vibe coding may not be able to replace the hardest part of software. John is saying agentic multi-agent coding already does this. Each agent has a role. But I've also seen sometimes these either agents or these LLMs when I ask them to, okay, can you look into this code and find an issue? It'll find some issue, then fix it. Then I say, okay, look again, and then again find an issue and fix it. I don't know. I mean, because it is probabilistic, every time it looks at it, might be find something different. Right? Where to find a list of AI graveyard? I think I shared it in some of the previous meeting, but I mean, I created my own list based on what I'm seeing. A lot of companies that have been beaten down. Right? Tom is saying Intuit is down on rumors, however, unlike that Trump will do away with personal income taxes. All right, good. I will be for it. Yeah, do away with the personal income tax. But idea maybe they'll tax it from some other way, right? If you increase the tariff, companies will gonna basically increase the prices. Government will still need to generate revenue, and then companies will still need to maintain the margins. In this in the consumption cycle, who actually pays for the goods at the end of the day? It's the consumer that pays for the goods, right? So whether you can say I will extract some from a tariff perspective, in this whole cycle the money comes from a consumer, so eventually it will come back to us unless companies start to reduce their margins. It's the same stuff like in real estate, and I could never understand that why there was, like we were saying, the buyer agent doesn't have to pay anything. Is the seller has to pay the agent fee of both the buyer agent and seller agent, and that never made sense to me, that the seller is actually paying. No, who is paying the money in this transaction is the buyer who's buying the house, so seller will just pass it on to buyer, right? When you're pricing your house, you already assume that you're going to pay to the buyer agent. You'll just bump up your pricing for that house, assuming you're going to pay whatever 2-3% to the buyer agent. So it never made sense to me whenever they say, oh, come on, as a buyer, you don't have to pay the agent fee. Come on, I have to pay, but under a different category. I will just categorize it as a housing price. I'll not categorize that as my buyer agent fee, because it's a buyer in this transaction who is taking the money out and then distributing, and then that get distributed to seller agent or to the buyer agent. So in this whole consumption of goods is a consumer who is paying it. Some of them will get distributed back to companies because they paid higher tariffs and all the stuff, but it's a consumer who's paying it, no one else. right? Anyway, so that's all around halo effect. Any other questions? Let me see. Perhaps it has a chance to impact prices of Intuit shares. Andre says no, all the tariff refunds are going to the company. The importer can bear some of the cost, but they'll be, yeah. See, as long as if they're willing to cut on their margins, sure. But if they're not cutting on their margins, or if the exporter is both sides, right? If exporter doesn't want to cut down on their margins, and then the importer doesn't want to cut down on their margins, it's the consumer is the only party that is actually will be paying in this transaction. Then we'll have to pay for it. Alrighty, so that was all around the Halo stuff. Hopefully I didn't miss any other questions. Let's continue on the what else did I see in the market. Or maybe so another article, this was in the Financial Times, on in the market right now we are seeing a lot of chip-backed loans versus focus from cash flow based to asset based lending that we are seeing in the market. And the reason why I want to bring that up is this is what we are seeing in a lot of these newbie data center, right? Neo data center companies, neo cloud companies like CoreWeaves, Irons, and the Nebius of the world, who don't have cash to build the data centers. So what all these companies are doing, they are basically buying or basically borrowing the money based on putting the, let's say, your NVIDIA chips as a collateral. So basically it is asset backed lending rather than your cash flow back, which is based on if your business is generating X amount of a cash flow, you can pay, the lender will be able to give you some capital because they know that this is the cash flow that they're paying. Right now, all that is based on how many NVIDIA GPUs you have. And increasingly, we are seeing a lot of these tech companies are doing it as a chip as a collateral, right? The companies that are involved in are kind of Apollo, Blackstone, which are basically lending funds to Iron or Meta, which are backed by just the chips. And who are the borrowers? Like CoreWeave, some other equity partners which are involved in creating those special purpose vehicles, etc. Why I want to talk about this is, again, if you are looking at from an AI thematic perspective, right, all your a lot of AI evaluations are being, if let me put it the other way around, if your business and your capital structure is depending on the same asset, I have seen that if in the downturn market, that doesn't end up well, right? If your business is dependent on consumption of your power from of NVIDIA chips, and your capital structure in which you've taken a lot of a debt, that is also dependent on the value of those chips, you're going to get a double whammy if the value of these NVIDIA chips, which are backing your loans, go down for any reason. For whatever reason, maybe in a year or 2 years, we figure out, oh, AI is not that great. I'm not willing to pay so much for your computing power. And then NVIDIA can't, the value of the chips that you hold in your data center has gone down. And that means the value of the collateral, not only you won't be able to charge the same pricing for your consumers for the computing resources, and also the value of the collateral has come down from the debt that you have taken. That is never businesses end up into getting into double whammy whenever I see that your core business as well as your loan, etc., is depending on a single asset. Just want to share. I don't know when this will happen, but I would be careful when I would have to think about this if you're investing in core, weave, or iron, etc. Anyone who are doing this asset-backed lending. That's the one reason why a lot of these companies like Meta, etc., have created a separate vehicle to separate it out from their business so that all the loans that is being taken doesn't appear on Meta's balance sheet. For that matter, I think even Alphabet has done it so that they keep their own company's balance sheet separate and the data center, all the loan on a separate balance sheet. On the rest, I'm sure consumer. Okay, so that we all looked at. James, companies are taking loans on GPU chips to get cash to build infra. What can go wrong? Yeah. On the other end, the companies are Nvidia is also sponsoring some of those, right? Other thing, okay, let me read last comment from Ray. If the value of the chips backing the loan go down, would the borrower benefit because they can default on a loan, and the lender would only see the now low value chips? Yeah, but the defaulter will go out of business. Is not going to benefit. He'll be out of business. Right? You go to default, you're going to go bankrupt. Right? So they'll be out of business. And that's what my concern is. And if you're investing on some of those companies, you got to be careful. Okay, another interesting one, and I'll invite thoughts from those who are more trader. S&P has been trading in a very narrow range, and we never seen this like say in the last almost 60 years since 1966. S&P traded within 2.7% range since the start of this year. This is the tightest in the century outside of 1944 and 1966. Right? However, individual stocks are a lot more volatile. So there's something called dispersion trade. Today morning I tried to look into this, and I didn't have enough time to even understand, how exactly hedge funds take advantage of it. Let me ask a question to you guys and put it open to you. Have you guys heard of a dispersion trade? Because now this has become a lot of hedge funds are now using this to take advantage of low index level volatility or low index level movement. Even the vol is higher, the implied volatility is higher, but the actual movement of SPY is very less. It's been less like ever since 1966. So they're selling index volatility and they're basically buying single stock volatility because the individual stocks underneath that index, many of the individual stocks have much higher movements than the overall stock. So this is something called dispersion trade. Any one of you heard about this? Especially those who are like full-time trade. I don't expect anyone like who are part-time or along with the jobs. Uh, but anyone heard about it? Haven't used? Have used? Dispersion is provided CBOE. Shri, could you elaborate on this one? What do you mean by this? Provided by dispersion is like a value. What does CBOE provides? I still have to figure out what exactly how the hedge funds use, etc. All right, so you know the deal. Oh, where is it? I'll have to use the same rule for everyone else. So to check our camera. Tom is saying is that SPX data for comparable first 2 months or for the full? This is for the first 2 months. S&P. That's the tightest range. Anyway, so I thought today morning I saw this on Bloomberg, and then I said, "Well, I'll have to figure out what the heck this is, but maybe I'll bring it up in this meeting if any one of you have done this dispersion trade. Looks like hedge fund managers are doing this because now you're seeing this in the market. S&P 500 stocks on the move. I'm looking at the top gainers for this week. Number one is TTD. I apologize for the maybe APP, Expedia, Intuit, maybe Lyndall Bessel, now Datadog, Workday. A lot of these software companies came back to life because I think market is nothing. Maybe these won't be dead, right? CrowdStrike is up 14% for the week. Palo Alto net worth 11%, Paycom 11%, XYZ, which is Block, Adobe, BBY. Is that a Bed Bath and Beyond? BBY? BBY. Oh, sorry, Best Buy. So these are the top gainers and these are the top losers. Corning, PSKY. What is PSKY? Anyone read PSKY? Oh, Paramount. This is the winner's curse. Paramount is gonna buy the assets of Warner Brothers. SanDisk, I think the airline stock got hammered, so LUV, Southwest, Estée Lauder, Lam Research, Ford. What happened to Ford? I knew Ford was down, but was there any news around Ford? Does anyone know what happened with Ford? On semiconductor, so on and so forth. Right. Any thoughts on Ford? Anyone knows what happened on Ford? Higher oil prices, but I didn't see any, like GM is not in the list. So why is Ford had issues and GM, how did GM perform? Yeah, down much lesser than Ford though. Right. Another also impacting CLF and STLD. CLF, I think, is Cleveland Cliffs. What is STLD? STLD. Steel Dynamics. See, so some of the tickers I've never heard. I don't think in all these meetings anyone ever brought up in the last 6 years STLD. You bring some, undiscovered, not talked about tickers, which is great. $18 billion revenue, looking at $26 billion market cap company. What I'm more interested is a couple of CEOs who basically put money where their mouth was, right? So Greg Abel, who took over a CEO role from Warren Buffett starting this year, I've yet to go and read his shareholder letter, which I will do this week, maybe tomorrow or today, depending on when I get a time. But he was on CNBC, and this is what he talked about. He says he used his entire after-tax salary to purchase his Class A shares for 15.3 million. Not only this, but he's also committed to do this every year that he's CEO. Right? I wish all the CEOs of my companies do the same stuff. And I think the host Becky Quick said, I can't imagine any other corporate leader doing this. Right? This is exactly putting money where her mouth is. Now, whether he should do it or not is a different, right? As a responsible money manager for managing the money for their family, whether it's the right thing to do or not, that's a different one. But as for me as an investor, when the CEO says, I am with you on the same boat, with I'm all in this, all my salary going here, I have at least a little bit more, assured that okay, I've got a company of CEO. Number two, which is more important, Berkshire started repurchasing shares now. It's the first time since May 2024. And I think this is the first, probably says that because of a change in the leadership, he wanted to put this out to their shareholders that they are starting buying the repurchase of Berkshire shares. But he's not going to tell this in all his, subsequent annual reports or quarterly reports. So, but he thought it was a prudent because of change in management to let investors know. But that's it for the first time. Next time, whenever they want to do a repurchase, you'll only get to know after they've done the repurchase. When you know, get their quarterly reports. They don't do quarterly reports. I think they do only annual reports. But they do provide a file with the SEC, but the report they only give for a shareholder. There are, I think, only annual reports. Otherwise, you can go and look into their 10Ks. The other CEO, which also put money where their mouth was, again, Jeff Green, which is CEO of the Trade Desk. And I've looked into his Form 4 filing with the SEC. I'll spare you all that, but I'll give you the gist of it. The bloody spent almost $150 million in buying Trade Desk shares. Again, I tried to find out a reason. He did give his reasoning why he bought it, but he's a CEO, obviously gonna talk great things about the company. I've not read through it completely. I started reading it, but then I realized I need to jump into the meeting, stop doing it. But you can go and look at his reasoning. But this is the biggest purchase that he has ever done in his history of this company. And he's been the CEO ever since the founding of the company. He's the founder and CEO. So, and right now, if you look at a Trade Desk, the stock has been down. Let's go back. It was on the best performing stock. It's been year to date, it's still down 22%, even though it's been up 26% this week. But still, it's down year to date, it's down 22%. So the share has been beaten down because a lot of growth slowing down. It's a growth stock. A lot of pricing valuation was based on growth. And then the Amazon kind of came into their space. And since then, we have seen stock got re-rated and the stock price got hammered multiple times on Trade Desk, right? And I know some of probably you hold Trade Desk. You reached out and we talked about it. I hold Trade Desk. I'm not going to sell off my stocks, especially at the time when the CEO has done its biggest purchase. At least I do want to go and look at it, the reasoning behind what he has done. So I'll still hold off. Look at it like 5 year stock has been cut in half. Right? Zero returns if you've been in the stock and you held it for 5 years so far. So the stock is where it was in 2020, given up almost 6 years of gains. This is where it was during the COVID. Like just right after COVID, we're back there. Oh no, right now the stock is here. Okay, and not too much of a difference anyway. We're back where we were during the COVID time. 6 years washed out on traders. This is what happens when you where the growing company stops growing, and then all the re-rating happens because hey, I paid you so much for the growth, and I'm not seeing the growth. But I won't be selling the stock, especially when Jeff Green has taken 150 million position. My position is way smaller than that. Hey Johnson, will you be attending Omaha annual meeting this year? Yes, I will go to Omaha. I'm just trying to figure out which day to go because there are other investing conferences that happen during that week. And unfortunately, I think Markel, which happens on Sunday, they're not doing this year in Omaha, which is like a sad part. So I'm trying to figure out, okay, which other conferences can I attend? And then basically that will decide how many days I'll stay on Omaha. But yes, but I do plan to go to Omaha. Yeah. If any one of you are going, yeah, let's sync up. Maybe we can meet in person over there. All right, we just hit our 12 mark, and so I'll skip some of the other stuff uh, and quickly jump onto crypto, and then I'll open up the breakout room. So crypto, not much of oops, I don't think I actually took a latest on the crypto. So let me go on to the crypto side and see anything has changed or not much. I know we were at 72 at some part of a time, then going back to the range that we have been around for where we were last week, right? Last week we were like 65. Now this week we are 7. But couple of news that caught my attention, which bode well for a crypto, is number one, Kraken secure the Federal Reserve master account, so they don't have to wait don't have to depend on any correspondent bank to deal with the Fed Reserve. And now they are in the same league as big banks like JP Morgans and the Wells Fargo's of the world, which is a good news from a crypto perspective. Again, we have turned around 360-degree from a previous administration wherein none of these companies were allowed to even have banking services like Checkpoint 2.0, and then they were dependent on an intermediate bank for all the services. Now they got a reserve account, reserve master account with a Fed, so they're not dependent and number on any other correspondent bank. This is the good news because I'll skip the details around, it basically tells that, hey, the Fed is also giving same respect to crypto companies as you would have it any other companies. I specifically remember, I think Caitlin Long, the bank, I forgot the name of the bank. It starts with A. If anyone remembers, now I can't figure it out. They had applied for Federal Reserve Master account many years ago and went into lengthy process. And without giving any reason, Fed told that they're not going to give. Right? I think they tried to sue Fed on that. No, it's not a firm. It's another bank. Whereas they want to do 100%, over collateralized loans and all that stuff. But because the administration was anti-crypto, they just first kept delaying and then they rejected it. But now good to see that at least Kraken got through it. And I expect, some of the other banks will also get through, and apply for, get a Fed master account. Okay, second thing more important was SEC submitted a new framework for your, again, this is in process for your capital market structure bill, FIT, or the Clarity Act. New laws which will govern on what's the token, what's the security, what's the not security, what's the commodity, all that stuff. Again, crypto market is been patiently waiting, and hopefully maybe in 2026 we will have that clarity will pass, and which will give a lot of clarity to the industry players on what is what, which regulator they will be regulating this industry. What does get classified as a security? Does something that is initially classified as security could become a commodity later on or not? All those questions will get answered hopefully in the Clarity Act, which is right now still stuck with our Congress. So that's on the crypto side, right? And then we saw 11 major firms. Now they applied for bank charters. Maybe once they get a bank charters, some of them probably will apply for Fed Master account as well. But good progress, some good progress on the crypto side. But I think unless we get a little more regulatory clarity, this is probably gonna stay range bound. And if anything that I observed over the last 5-6 months, it is actually trading more like a risk on asset. And so your thesis might have to change. Anyways, that's all about today. 10 minutes over, but I'll open up the breakout rooms now, and I'll stay on a lobby. You want to talk about any of the different topic, feel free to join some of the breakout rooms, and talk with other investors/traders.